Hello everyone. Today we're going to talk about individual tax credits. So something to keep in mind is a tax credit directly reduces a taxpayer's liability on a dollar for dollar basis, which means it is more valuable than a tax deduction of the same dollar amount that only reduces the amount of taxable income. Various types of tax credits are either refundable or non-refundable. Some of the non-refundable tax credits are the foreign tax credit, adoption credit, American Opportunity Tax Credit, lifetime learning credit, retirement savings contributions credit, or the Savers credit as it is sometimes referred to, the credit for other dependents, the child and dependent care credit, and then the child and tax credit or child tax credit. And something to take note of is the Child and Dependent Care Credit is no longer refundable in 2022. Refundable tax credits are Additional Child Tax Credit, the Earned Income Tax Credit, the Premium Tax Credit, the American Opportunity Tax Credit, and the credit for excess Social Security and RRTA tax withheld. The Child and Dependent Care Credit is not refundable in 2022. The credit allows a taxpayer a credit for a percentage of child care expenses for children under age 13 and or for disabled dependents of any age. This is a credit for child care expenses that allow taxpayers to work or to seek work. If a taxpayer receives a reimbursement under a flexible spending account, the amount is treated as being pre-tax and the taxpayer must deduct the reimbursed amount from his qualified expenses to determine the credit. Let's give a quick example. Zane and Sherry both work full-time and file jointly. They have 2 children, a daughter who is 4 years old and a son that is 2 years old. Zane and Sherry incur $5,000 of daycare expenses for their daughter and $4,600 for their son. Their total child care expenses are $9,600 for the year. The maximum amount of qualifying expenses they can use to figure the credit is $6,000, even though their actual expenses exceed that amount, and that is based on the 2022 tax year. Qualifying expenses for the Child and Dependent Care Credit are preschool education, after-school care, disabled care, transportation costs, fees and deposits, household services. I'd like to talk about the child tax credit and additional child tax credit. The child tax credit expansion is instituted by the American Rescue Plan Act expired at the end of 2021. Prior law parameters instituted by the Tax Cuts and Jobs Act are in effect again for tax years 2022 to 2025. The rules for the child tax credit and the additional child tax credit are as follows. The non-refundable child tax credit is $2,000 per qualifying child, and the refundable additional child tax credit is a maximum of $1,500 per qualifying child in 2022. Something to note, the Big Beautiful Bill has now increased the child tax credit to $2,200 per qualifying child. To be a qualifying child for the child tax credit, you must pass the age test, the relationship test, the support test, the dependency test, the joint return test, the citizenship test, and the residency test. There is a credit for other dependents, also known as the ODC credit. This is a $500 credit for other dependents or other dependent credit that applies to dependents who do not qualify for the child tax credit, such as children who are over the age threshold or other dependents such as elderly parents. Taxpayers cannot claim the ODC credit for themselves or a spouse. In other words, the credit is only available for dependents who are listed on the return. The dependent must be a U.S. citizen, U.S. national, or U.S. resident. I want to talk about the 2 education credits that are available to taxpayers. The American Opportunity Tax Credit, also known as the AOC or AOTC, and the Lifetime Learning Credit. The American Opportunity Credit allows taxpayers to claim a maximum credit up to $2,500 for each eligible student. The credit covers 100% of the first $2,000 and 25% of the second $2,000 of eligible expenses per student. Qualified expenses include tuition and required fees, books, supplies, equipment, and other required course materials, but not room and board or student health fees. Here is an example. Bradford is a college senior studying to be a dentist. This year, in addition to tuition, he pays a $350 fee to the university for the rental of the dental equipment he is required to use in his medical training program. Bradford's equipment rental fee is a qualified education expense. The American Opportunity Tax Credit is partially refundable. Up to 40% of the credit is refundable, which means the taxpayer can receive up to $1,000 even if no taxes are owed. The credit is not refundable if the student is subject to the kiddie tax rules. Requirements for the AOTC are as follows. There is a degree requirement, a workload requirement, no felony drug conviction requirement, and 4 years of post-secondary education requirement. The Lifetime Learning Credit is a non-refundable tax credit of 20% of qualified tuition fees and any amounts paid directly to the educational institution for required books, supplies, and equipment up to $10,000 paid during the tax year. The maximum credit is $2,000 per tax return, not per student. A family's maximum credit is the same regardless of the number of qualified students. The requirement for the Lifetime Learning Credit differ from those of the AOTC credit, which are no workload requirement, non-degree courses eligible, all levels of post-secondary education, an unlimited number of years. Felony drug convictions are permissible. Now I'd like to go ahead and talk about the Earned Income Tax Credit. The Earned Income Tax Credit, also commonly known as the Earned Income Credit, is a refundable tax credit for lower income people who work and have earned income and adjusted gross income under certain thresholds. The credit is claimed on Schedule EIC, Earned Income Credit. The Earned Income and AGI limits. The amount of the credit varies based on a taxpayer's earnings and how many children are claimed as dependents on the return. Both a taxpayer's earned income and their AGI must be less than the following limits. The following limits include children claimed. 0 children claimed, or also known as the childless EITC credit. There is children claimed of 1, children claimed of 2, and children claimed of 3 or more. And the maximum AGI threshold changes based on if you're claiming 1 child, 2 children, or 3 or more. Let's give a quick example. Sarah and Gilroy are married and their joint AGI is $56,900 in 2022. They have 1 child, age 10, at the beginning of the tax year. Normally, they would not qualify for the EITC because of their income level. However, Sarah becomes pregnant at the beginning of the year and gives birth to twins right on December 31st, 2022. Now Sarah and Gilroy have 3 children, their 10-year-old son plus 2 infant twins. They qualify to claim EITC in 2022 because their AGI is now below the threshold for taxpayers with 3 or more qualifying children. Lastly, I want to talk about the Retirement Savings Contribution Credit. The credit is a 10 to 50% of eligible contributions to IRAs and other qualifying retirement plans up to a maximum credit of 2,000 MFJ, or married filing jointly, depending on a taxpayer's adjusted gross income. Well, guys, we've talked about all the individual tax credits that are applicable to your work. Please continue listening to the channel, and if you have any questions or comments, feel free to drop it in the comment section, and I'll be as responsive as I can and get those questions answered.